All right. In this video, we're going to work on the the workbook exercise AP15B. And here in this problem, we've got a breakdown similar to what we saw in chapter 1, but now, business focused. Here we've got this company, and we've got a balance sheet, an income statement, and a bunch of transactions here that we are going to account for. And one thing to know in this problem is there's no beginning balances like we had in chapter 1 on the things that we worked on the transactions, because this problem says that the business was opened on March 1st. We're recording March's transactions, and so there's no opening balances because it wasn't open at the beginning of the month. So we'll have nothing to put in our opening boxes here, so just keep that in mind. Okay, so let's start looking at the transactions here. The first one says that $30,000 was transferred from the owner's personal bank account to the business bank account. So we'll put in $30,000 on the increase side, and that's an increase in the business's cash assets. And then we're going to put that onto the side of down here in capital. So here we've got capital. And so now the business has cash and the owner has equity recorded, and capital is the specific sub-account under the equity header that ties to the specific owner of that owner. You could have multiple owners. That's why we have these individual accounts. In most of the transactions we look at in this class, there's only one owner, so really there's just one capital account. But theoretically, if you had a partnership, there could be multiple capital accounts, and those can be impacted differently based on transactions. So just something to keep in mind, but that's how we account for it. You can see the increase on the left, the increase on the right. We're balancing. Everything's looking good. Okay, the second transaction says that we provided services for $3,000 cash. So we provided the services and they paid us right away. And so we're going to record revenue. We're going to record that on the increase side. And then we're going to record an increase to cash here on the left side. So again, we're balancing. Cash is increasing. Eventually, equity will increase for this revenue as it calculates down to, I need to update this, where it says net income. If we have net income, our equity will increase there. Bear with me here. Sorry, I just realized I forgot to update this from the first chapter. In your version of the spreadsheet, I'll save this down so you won't have to make those changes. They'll already be done for you, so keep that in mind. Okay, transaction 3, we purchased office and computer equipment worth $8,000 on account, which will be paid next month. So those are all important things to keep in mind. So here are the things we can know. We purchased, so we got some office and computer equipment. So let's look at, here's our equipment account. So it was $8,000. Equipment increased. And we didn't pay cash for it, so cash won't decrease, but instead we bought it on account, which in other words means that we purchased it on credit. We have some sort of liability for that purchase that we'll need to pay in the future. And we're going to record that in this new account that we are using in chapter 2 going forward, called accounts payable. And remember that this is a liability that will reflect all of the payments that we will need to make in the future. And we bought the equipment, we haven't paid it yet, so we're going to have to pay that in the future. So we're going to book in $8,000 increase to our liability to offset the increase in assets to make it balance, right? So we're good there. Okie dokie. Let's see here. We paid $1,100 cash for meals and entertainment. So we'll put $1,100 decrease to cash. And, whoops, 1,100, not 11,000. $1,100 increase to our meals and entertainment expense. Okay. We paid insurance expense with $800 cash. So we'll reduce cash and we'll increase insurance expense. And note, we talk a lot about prepaid insurance. In this example, it doesn't say anything about a prepayment or that we're paying multiple months at once or anything like that. It just says we're paying insurance expense with one payment. So we don't do any kind of prepaid expense in this instance. We just record the expense associated with an insurance charge. Okay, number 6, we perform services for clients for $4,000 on account. So again, we're going to record the revenue because we earned it now. It's owed to us, but we didn't get paid yet. So now we're being paid on account. Earlier we bought something on account, but now we're the ones who will need to be paid later. And so when we're going to be paid later, we want to record the revenue, but we haven't yet got the cash. So we use this new account called accounts receivable, which is used to represent the fact that we're going to receive some cash in the future, and $4,000. So you can see the credit here for receivables, the credit for revenue, and then later when they actually pay us, we'll see an increase to cash and a decrease to that receivable to make it go to zero. And that's kind of the overall flow of how that works, and we'll see some examples of that and practice with that in class and in homework problems. Okay, so number 7, we paid $600 cash for miscellaneous expenses. So cash goes down. We didn't pay it on credit or on account or anything. We just paid with cash, so that's the decrease there, decrease in the assets. Number 8, we received a utility bill of $1,000 to be paid next month. So again, we want to record our expense now. Even though we didn't pay cash, that doesn't matter. We're going to increase expenses for utilities because we use them this month in March. But we're going to pay the bill next month. So we're not going to affect cash now. We're not paying it now. But we're going to record a liability into accounts payable to reflect the fact that we're going to pay this in the future. Right? It's a payable. It's going to be paid. And it's an increase to our liability. So we owe this amount to the utility company, but we're going to record the expense this month because it related to March, the utilities that we used up. Okay, number 9, we paid $1,200 cash, so cash goes down, and this is for office rent. Again, it's not prepaid rent, it's just office rent for the 1 month, so it's just going to be rent expense and a reduction in cash. Paid $1,000 to the salary to our assistant, so we're going to reduce cash by $1,000 and record salaries expense. Okay, then we collected 50% of the balance owed from clients for services provided earlier this month. So you can see that the client owes us $4,000, right? And we collected 50% of that balance, so they paid us half of this receivable. So we can reduce that receivable by half of 2,000, and we can increase cash by 2,000 to reflect the fact that they paid us half of the amount that we were going to receive. Okay. And finally, we received $1,000 cash for services to be performed in 3 months. So now we're getting cash. Again, cash goes up, but we haven't earned this cash yet. Okay. So we're going to do this work in 3 months, not this month. And so we can't record revenue because we haven't earned that revenue yet. So instead, we record the cash. It's in our accounts. We're holding this client's, this customer's prepayment, but we are going to put that as a liability to unearned revenue because we have not yet earned this cash that we're holding. So we're just holding it for them essentially. Once we do the service and we've earned that money, we'll get rid of this liability and record it to increase revenues. But until that point happens, it's going to sit on our books as a liability. And if the customer ends up canceling the services or something, and we never end up providing them the services, we never earn the revenue, we would just refund this $1,000 cash back to the customer, which would reduce cash and get rid of that unearned revenue liability. So it's a little tricky. People struggle with unearned revenue, but hopefully that helps a little bit, and we'll practice quite a bit. Okay. Cool. Okay, I think we've got everything recorded now. So let's go ahead now and do our summations. So I'm just going to go in here. I'm going to use that auto sum function. That's going to click on this button here. It automatically puts in a formula to add everything above. Whoop, until I messed it up. Try that again. Okay, there's that. And I want to show you a little trick here. So we now have this formula that says sum up everything in these B10 to B15 cells. So everything here, right? And a real easy way, because we also want to sum up everything here. And so if we can kind of just copy this formula over, it makes it easy to not have to it's not hard to push the button again, but I want to teach you this methodology. So if you click into this cell, you see the highlighted thing there. You put your cursor over the bottom right. You see how it changes to kind of that black cross there. Hold your left key down, and you can drag that formula over. And now you're going to have the same formula in these cells. So now you've kind of copied that in a way, or you've dragged it and pasted it doing there. So you basically copied the formula in here. That automatically updates there. So we have 36,000 increases, 4,700 decrease. So we take the bigger minus the smaller. We end up with cash of 31,300. Okay. Again, I'm going to use the auto sum feature, just drag that across, and then I'm going to go into this cell and say equals 4,000, the bigger minus the smaller. So we still have $2,000 of receivables. Remember, they paid us half of the balance that was owed. So they originally owed us 4,000. They paid us half, and they still owe us another 2,000. So if we were to look in our books, we'd know, oh, this customer owes us $2,000 still, right? And that's important. Okay, we just had one transaction to the equipment account, so there's nothing to subtract from the two totals, but we can just pull all that down. Accounts payable, similar, just increases. We can look at this and say, oh, we owe $9,000. In our systems, we'll have the detail of who this is owed to, and we'll make sure that way we can track our payments and make sure we don't miss a payment and all that. Just the one unearned transaction revenue. And similarly with capital, the way that the book works with equity, you saw this in the net worth chapter. We are going to adjust equity by the net income or loss, but for the purposes of reflecting the activity in the T account, we're not going to show that effect there. We're just going to represent that it has increased here. You can bear with me as I update that from net worth from chapter 1. Okay, so let's auto sum our numbers there. And then we're just going to drag these all down. And I'm just going to teach you a little Excel trick here as well. So again, up here I talked about the ability to drag formulas across. Another way to copy a formula, if it makes sense to do so, is just to click into the cell. And this formula is just saying take what's above this and just equals that. It's the same thing. And basically we're going to want to do that with each of the expense accounts. So we just want to copy this down. And it's pretty easy to just go through and say equals and click. But just for the sake of learning a little skill here, we can click on this formula that just says take what's ever above. We can copy that, or you can do Control-C to copy. And then we can paste that formula into here. And it'll just basically change what the cell references. So this one references the one above it. Now this one references the one right above it. And again, we can copy and paste there, paste there, paste there, and paste there to just bring down the totals. It's a little redundant, and it doesn't make a lot of sense really in this instance, practically speaking, to have this listed twice. But in reality, usually if you had more than one expense transaction like you see in cash or here, this would be a summation and it would be a total there. So just something to keep in mind. Okay, now we're just going to reference the revenue, and we're going to add together all of the expense totals. I'm just doing a formula to add each one of those cells together and then hit enter. So revenue was 7,000. Expenses were 5,700. So revenue minus expenses gets us net income of $1,300. Okay, and we're almost finished. Let's add up all of our assets. So again, we just do a formula to add these three different cells for assets. Let's see how many, 2 different liability accounts. And then owner's equity, remember we're taking this balance and we're going to increase it. Whoops, take that balance plus the net income to give us 33,100. Okay, and then we're going to add liabilities and owner's equity. And what we should see is that liabilities plus owner's equity equals assets, and that is what we see. So it looks like we put everything in and we balance, and we are good to go. All right, well, thanks everyone. Hopefully that was helpful. And like I said, I did make some edits while I was making this video to where it said net worth. In the copy that I will upload to Canvas for you all to work in, the blank template, I will update those titles for net worth to owner's equity. So you won't have to make the same changes that I have made in the video. But yeah, all right. Well, I'll see you in the next video for the homework. The workbook exercises for Chapter 2, and we will finish up here with AP 16B. All right. Thanks, everyone. We'll see you in the next video.